So, as many of you would know in the room, you guys hosted the French president with varied results. Talking about one continent, one partnership, a new page to start on and move forward in. So we've gone with the macro. We talk about this wonderful continent, Africa, with 54 states in it. Let's go to the micro. Let's look here in the Kenyan market and zoom in on the residential space. So it's a pleasure to call to the stage a presentation from a dearest dada of mine, Sakina, to come to take the mic and give us 15 minutes on what is going on right here.
Thank you, ladies and gentlemen, for joining us today to talk about some of the changes we at HAS are seeing in the real estate industry in Nairobi and in Kenya. I have grown up in this real estate industry, born to it, raised in it, and for many years now involved in shaping it. And yet I would say the changes we are seeing now in how people want to live, buy, and invest are among the most significant I have witnessed in my lifetime. The signs of the change are written across all our index data in 2025 and 2026. Perhaps the most central of these is the mix of fortunes for apartment developers. For many years, this has been a high-margin sector built on high densities and financed with off-plan installments. This model has bridged across our scarcity of financing to the available wealth of buyers and incomes of residents in a low-cost outcome with low-cost financing that has delivered hundreds of thousands of new homes into our market. But the formula has been disrupted lately on several fronts. Yet at the very same time, as part of the apartment sector are beginning to show signs of strain, house prices have continued to rise robustly across much of the market. It is an unusual divergence and one that suggests that residential market may be entering a very different phase from the one that defined the last decade. Then, to add to this mix of trails, we see land buying for residential development performing robustly and going like a rocket in areas that relatively few formal employment centers and no traditional CBD structure. Together, these trails point to shifts in demand that are deeper, more structural, and perhaps still not fully understood. At the heart of these shifts has been the surge in the cost of building, with the cost of building materials rising by as much as 20% between 2022 and 2024. This has eaten hard into affordability in the apartments market, at the same time as we have seen a swath of new industry entrants, increasing competition and supply, and in a near-perfect storm, rising economic pressures on the middle classes occupying these legions of new homes. Developers have worked to slash costs by value engineering design, materials, and construction methodologies. For mid-market offerings, the greater use of local materials has somewhat protected them, with most of the prices falling on imports. But for premium apartments, the squeeze has been severe, pushing developers to increase densities and lower cost of land. For houses, the expense and ticket price have made financing a long-term issue by reducing the scope for off-plan purchasing. But the cost solutions have diverged from demand. As it is, apartments are still selling well with globally high yields, but their developers have been caught between costs, competitors, and consumers on profits, while capital outlay has continued to keep developers from building standalone houses that premium consumers want to buy. It's worth noting here that Nairobi's strong positioning as an international city is often cited as the grand driver of our real estate, whereas in fact, our expat economy is shrinking. Sweeping aid cuts, remote working, and localization have all cut into Kenya's expat population. Our prime market still draws many international investors, but the residents of our homes are substantially Kenyan professionals. That is still a growing demographic, and it is a growing pipeline of both buyers and residents. The data now reveals a consistent pipeline of apartment supply, with localized oversupply risks emerging as developers increasingly converge on the same high-density zones without real-time visibility into competing supply, while housing remains structurally undersupplied. Our real estate is exceptionally robust by international standards. The near absence of debt leveraging due to our constrained mortgage market means our property is delinked from interest rate pressures and protected from waves of defaults of the type seen elsewhere in the world, which depressed prices and even famously triggered the 2008 financial crisis. But our insulation does not rise above the fundamentals of investment. The majority of our purchasing is by investors who earn incomes from rentals as well as capital appreciation. That sum has been at return levels amongst the highest in the world for real estate, and yields are holding up as at now, despite flat rents. But at a nuanced level, poor rental uptake starts to erode the strength of properties as investment assets, and our rents have markedly been flat and even falling recently as tenants have strained or moved. And the moving is very visible when we look at land price trends. While Nairobi land prices have risen by 20% since 2020, land prices in our satellite towns have risen by 49%, and some areas of the coast have absolutely rocketed, most notably Diani, Watamu, Lamu, and Bamburi. This mix of stilled growth in rental incomes and racing growth in some land prices becomes a cohesive picture only when we study our very segmented market. Investors are still our strongest buyers, buying for wealth creation. They need properties that are attractive to their target markets and feel readily generating good returns. But we have seen a diversion in the segmentation of these target markets. Around 80% of Kenyan professionals rent their urban homes, but where urban convenience was the priority for everyone, with higher or lower bars, we now see a real shift between those in the middle market and premium tenants. Premium tenants are far more likely to have benefited from some element of remote working, most often as hybrid working. This means more time in the home and a shift in priorities towards a home-based lifestyle versus ideally located, high-quality accommodation. At the same time, the middle market is now under increased financial pressure, so while these tenants are still commuting, costs are driving them outwards to satellite towns in search of lower rents. In this, new infrastructure developments are creating viable new nodes for developers who are keen to build on cheaper land to offset increased building costs. But these nodes still represent often small populations, and simultaneous developments can quickly overwhelm the market and set up sometimes very fierce rental competition to fill, meaning the cost squeeze simply moves with the developers to these new locations. For developers and investors, this makes real-time information essential and sight of the local building pipeline. Early investors have been and are doing well in these markets, but latecomers are not. For the new premium market, We're living through a generational change in priorities. That is the defining issue for success in this market in 2026 and the years ahead. Lifestyles for the premium generation were often built on city facilities and engagement. They were engaging in the workplace. They appreciated nodes close to excellent sports clubs, gyms, restaurants. They were not spending time cooking or even a lot of time being in the home. And they were not as isolated as they have become in the digital age. Now, they gravitate strongly to developments that offer lifestyle and hospitality facilities, open spaces, tranquility, greenery, meeting and entertainment areas, and even residential activities. They have become strongly averse to blocked views, noise, and they seek extra space indoors, but also outdoors, albeit maintained. Against this backdrop, the galloping land price growth at the coast is the extension of those most liberated from commuting and able to move to a new and wellness-oriented lifestyle at the coast. In our new Coastal Land Price Index, launched yesterday, and with our special report shared at EAPI today with all present, we look in detail at the buyers driving this market across diaspora buyers, tourism buyers, lifestyle buyers, remote workers, and speculative investors. The tourism buyers alone continue to expand at a very substantial pipeline, with studies computed in our report that suggest each year's tourism generates 200,000 to 300,000 tourists with at least aspirations to buy at the coast, either as a second home or in a full relocation. Likewise, internet access and lifestyle have aligned to draw new remote working communities and retirees, both domestic and international, into fueling significant land buying and property buying. Yet all these classes of investors most value beauty, meaning that Diani, boosted too by the enhanced access thanks to the Diani Road, has grown the most sharply by 79% since the end of 2020, followed by Watamu at 70%. Our report analyzes the constraint on available land at the coast, the beachfront premiums for each of 12 towns, and the factors that are slowing interest and price growth, as well as those that are lifting it. These span unclear land title or poor water access at one end, through to beach width and amenities at the other. Taken as a whole, the coalescence of these differing target markets and the pressures driving supply create a clear picture of future demand and success beacons. As house prices rise, the long undersupplied family housing segment is beginning to reemerge as a viable development opportunity. The satellite towns continue to open affordable entry points for middle market development, with seasoned investors only moving beyond the city with developers they trust to deliver and protect long-term value. The coast is emerging as perhaps our most converged residential hospitality market, absolutely focused on natural beauty, lifestyle and wellness, and a growing class of working people who no longer need to live where they work. Ultimately, I would say this: demand is not disappearing. Our population continues to grow. Our economy continues to consolidate its position as a regional and diplomatic hub, and capital continues to seek a home in real estate. But in a changing market, the question is no longer simply whether demand exists, but whether we are directing resources toward the right products in the right locations for the way people increasingly want to live. And ultimately, that is the purpose of our work at the Hass Index. Thank you.